Before we begin, please note that the content in this presentation is for educational and informational purposes only and should not be construed as financial or investment advice. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. This video is not a solicitation or an offer to buy or sell any currency. Past performance is not indicative of future results. You've seen it before, haven't you? You open up a financial news site, click on a currency pair like the euro versus the US dollar, and your screen is flooded with what looks like a failed EKG test. A chaotic jumble of red and green bars, jagged lines going up, down, and sideways. It feels overwhelming, like trying to read a foreign language you've never even heard spoken. One person looks at that chart and sees pure, unadulterated noise. Another person, looking at the exact same screen, sees a story. They see a battle between buyers and sellers, a visual record of fear and greed, and clues about where the price might be headed next. What's the difference between those two people? It's not a secret algorithm or a $5,000 piece of software. Simply the ability to read. And that is exactly what we are going to do in this series. We are going to give you the Rosetta Stone for the language of the financial markets. My goal is to take you from a state of confusion, where these charts feel intimidating, to a state of clarity, where you can look at any Forex chart and understand the basic story it's telling you. This isn't about predicting the future with 100% certainty. Nobody can do that. This is about learning to analyze the past and the present to make more informed decisions about potential future outcomes. This is the single most fundamental skill in trading. Without it, you're just gambling. With it, you're analyzing. Especially for us here in the United States, understanding these charts is critical. The US dollar is the world's reserve currency. It's on one side of nearly 90% of all global Forex transactions. Every time the Federal Reserve makes an announcement, every time a US jobs report comes out, the shockwaves are felt across the globe, and they are drawn in real time onto these charts. Whether you're looking at how the dollar stacks up against the euro, the Japanese yen, or the British pound, you are watching a direct reflection of global economics, and the US dollar is the main character in that story. Learning to read its movements gives you a powerful lens through which to view the world's financial health. So, where do we even begin? The biggest mistake most beginners make is trying to learn everything at once. They hear about dozens of complicated indicators, relative strength index, MACD, Bollinger Bands, Ichimoku clouds, and they pile them all onto their screen until their chart looks like a Jackson Pollock painting. It's a recipe for disaster, a classic case of analysis paralysis. We are not going to do that. We are going to do the opposite. We're going to strip it all down to the bare essentials. Think of it like learning to read a book. You don't start with Shakespeare. You start with the alphabet. You learn what the letters look like, what sounds they make, and how they combine to form simple words. In the world of chart reading, our alphabet is the candlestick. That little red or green bar is the most fundamental piece of information on your entire screen. It's a tiny, compact story of what happened over a specific period of time, whether that's 1 minute, 1 hour, 1 day, or 1 week. A single candlestick tells you 4 crucial pieces of data: where the price opened, where it closed, what the highest point was, and what the lowest point was. It tells you if the buyers were in control, pushing the price up, or if the sellers were in control, forcing the price down. It even tells you if there was a brutal fight between them that ended in a draw. Before you can understand the paragraph, you have to understand the word. And before you understand the word, you have to understand the letter. The candlestick is our letter. Once we've mastered the alphabet, the individual candlesticks, we'll start forming words and sentences. This is where we learn about support and resistance. This is probably the most important concept in all of technical analysis. All it means is that prices often seem to struggle to move past certain levels. Think of it like a floor and a ceiling in a room. Support is the floor that the price seems to bounce off of, and resistance is the ceiling that it seems to hit its head on. These aren't magical, invisible lines. They are zones of intense supply and demand. They are psychological battlegrounds where major decisions are being made by thousands of traders around the world. Identifying these levels on a chart is like finding the key plot points in a story. It's where the action happens. It's where the direction of the entire narrative can change in an instant. After we understand the key levels, the floors and the ceilings, we can finally start to read the story itself. This is the concept of a trend. Is the price generally making higher highs and higher lows, creating an uptrend? Or is it making lower lows and lower highs, creating a downtrend? Or is it just bouncing back and forth between a floor and a ceiling, going nowhere in what we call a range? The old saying in the market is, the trend is your friend. Understanding the direction of the main trend is like knowing if you're swimming with the current or against it. One is a lot easier than the other. By combining our knowledge of candlesticks with our ability to identify support and resistance, we can start to see these trends emerge from the noise. We can see the story unfolding. So let's be clear about the journey we're about to embark on. This is a foundational skill. It's not a get-rich-quick scheme. Learning to read charts is like learning any other valuable skill, whether it's playing the piano or learning a new language. It takes time, it takes practice, and it takes patience. This series is your instruction manual. I'm going to lay out the framework for you piece by piece in a way that is simple and easy to digest. We will focus only on what matters and ignore all the distracting noise. We will start with the absolute basics and build a solid foundation of knowledge, one brick at a time. By the end of this series, you won't just see lines on a screen anymore. You will see the rhythm of the market. You will see the psychology of the crowd. You will see the story. The first step in that journey is to understand our alphabet, the building block of every single chart you will ever see, the Japanese candlestick. And that is where our deep dive begins. Imagine you're looking at a single frame of a movie. That one frame can tell you so much. It can show you conflict, a moment of triumph, a hint of what's to come. A Japanese candlestick is exactly that. A single frame in the epic movie of the market. And just like a movie frame, it tells a story of a battle fought over a specific period of time between two opposing forces, the buyers and the sellers. The buyers, often called the bulls, are trying to push the price up. They believe the currency pair is undervalued and will be worth more in the future. They are the optimists, the aggressors pushing forward. The sellers, known as the bears, are trying to push the price down. They believe the currency pair is overvalued and will be worth less. They are the pessimists, the defenders pushing back. Every single candlestick you see on a chart is a visual summary of one round in this ongoing fight. It could be a 1-minute round, a 1-hour round, or even a 1-day round. The duration doesn't change the story. It only changes the timescale. So let's break down the anatomy of this story. Each candlestick has two main parts, the body and the wicks. The body is the thick, rectangular part. This is the heart of the action. It tells you where the price opened at the beginning of the period and where it closed at the end. Think of it as the main battlefield. The distance between the open and the close shows you the territory that was decisively won or lost during that session. Now, the color of that body is critical. In the United States, we typically see green and red candles. A green candle is a victory for the buyers, the bulls. It means the closing price was higher than the opening price. The market opened, and by the end of the period, the bulls had successfully pushed the price up. It's a sign of strength, of optimism. A red candle is a victory for the sellers, the bears. It means the closing price was lower than the opening price. The market opened, and the bears took control, driving the price down by the end of the session. It's a sign of weakness, of pessimism. So at a glance, green means up, red means down. Simple but powerful. But the story doesn't end with the body. That's where the wicks come in. The wicks, also called shadows, are the thin lines that stick out from the top and bottom of the body. These wicks tell you about the extremes of the battle. They show you the highest price and the lowest price that were reached during that period, even if the price didn't close there. Think of the wicks as scouting parties. The upper wick shows you the highest point the bulls managed to reach. They charged forward, deep into enemy territory, but couldn't hold that ground. The bears pushed them back down before the round ended. The very tip of that upper wick represents the high of the period. The lower wick shows you the lowest point the bears managed to reach. They drove the price down but couldn't keep it there. The bulls mounted a defense and pushed the price back up before the close. The very tip of that lower wick represents the low of the period. So every single candlestick gives you 4 key pieces of information, often called the OHLC. The open, where the price started. The high, the absolute highest point the price touched. The low, the absolute lowest point the price touched. And the close, where the price ended. Let's walk through a story. Imagine we're looking at a green bullish candle. The story goes like this. The trading period began at the bottom of the green body. That's the open. The sellers might have tried to push the price down, creating a small lower wick, but the buyers fought back. Then the buyers took control, pushing the price up, up all the way to the peak of the upper wick. That was the high of the session, a moment of maximum optimism. But at that peak, sellers saw an opportunity and started pushing back, forcing the price to retreat slightly. Finally, the bell rang, the period ended, and the price settled at the top of the green body. That's the close. Because the close is higher than the open, it was a clear victory for the buyers, and the candle is colored green. Now let's flip it and read the story of a red bearish candle. The period opened at the top of the red body. The buyers might have made a brief, optimistic push, creating a small upper wick, but they were quickly overwhelmed. The sellers took command, driving the price down all the way to the bottom of the lower wick. That was the low of the session, a moment of maximum pessimism. But at that low point, some buyers saw a bargain and started stepping in, providing some support and pushing the price back up a little. Finally, the session ended at the bottom of the red body, the close. Because the close is lower than the open, it was a decisive win for the sellers, and the candle is painted red. Understanding this dynamic is everything. The size of the body and the length of the wicks tell you even more about the psychology of the battle. A long green body with very short wicks? That's like a knockout punch by the buyers. They were in control from the open to the close. It signals strong, confident buying pressure. A long red body with short wicks? That's a knockout by the sellers. Overwhelming selling pressure. But what about a candle with a tiny little body and very long wicks on both the top and bottom? This shape is often called a spinning top. What story does that tell? It tells a story of immense conflict and ultimately indecision. The buyers pushed the price way up. The sellers pushed the price way down. They fought back and forth, a titanic struggle, but in the end, the price closed almost exactly where it started. Neither side could claim victory. It's a stalemate. It signals uncertainty in the market. And what if you see a candle with a long upper wick and a small body near the bottom? Think about that story. The buyers tried, they really tried. They pushed the price all the way up. But then they hit a wall of sellers who came in with overwhelming force and slammed the price all the way back down, erasing most of the buyers' gains. Even if the candle is green, that long upper wick is a warning sign. It's a story of a failed rally. It tells you that sellers are lurking at higher prices. Conversely, a candle with a long lower wick and a small body near the top tells the opposite story. The sellers were in control. They hammered the price down. But then from out of nowhere, a wave of buyers stepped in, rejected those lower prices, and drove the price all the way back up. This is a story of a failed sell-off. It's a sign that buyers are defending a certain price level. You see, each candle is a miniature drama. It's not just a red or green bar. It's a detailed account of the struggle between human fear and greed, optimism and pessimism, supply and demand, all condensed into one simple shape. Your first job as a chart reader isn't to predict the future. It's to accurately read the present. It's to look at the most recent candle and ask, who won the last battle, and how did they win it? Was it a decisive victory? Was it a hard-fought struggle? Was there a surprise comeback? This is the foundational skill. Before you can understand the paragraph, you must first understand the sentence. And before you can understand the sentence, you must know your letters. These individual candlesticks are the letters of the market's language. By learning to read them, you are no longer just looking at a squiggly line on a screen. You are starting to understand the order flow, the psychology, and the raw forces that move the largest financial market in the world. Now, a single letter doesn't mean much on its own. The real magic happens when these letters, these individual candlesticks, start to combine. They form words. They form sentences. They form patterns that have been observed and studied for centuries. These patterns can offer insights into the potential next chapter of the story. And understanding those patterns, how one candle's story flows into the next, is the bridge from reading the present to anticipating the future. And that bridge is built brick by brick with patterns. Think of these patterns not as magic formulas, but as the common phrases and idioms of the market's language. Just like in English we have phrases like a blessing in disguise or biting the bullet, the charts have their own recurring expressions that signal a certain sentiment or a potential shift in mood. These aren't guarantees, but they are historical echoes, conversations that have happened millions of times before in markets all over the world. Let's start with the most basic words in this new language, the single candle patterns. These are the simplest, most direct statements the market can make. Imagine the two extremes. On one hand, you have absolute, undeniable control. On the other, you have complete and total indecision. The candle that screams control is called the Maribozu. It's a Japanese word that means shaved head, and it's a perfect description. A Maribozu candle has a long, solid body and virtually no wicks on either end. It looks like a clean, solid rectangle. A green Maribozu means that from the moment the trading period opened to the moment it closed, the buyers, the bulls, were in complete command. The price opened at the low and closed at the high. There was no hesitation, no fight from the sellers. It was a stampede. Conversely, a red Maribozu tells the opposite story. The sellers, the bears, dominated from the opening bell to the closing bell. The price opened at the high and closed at the low. It was a statement of overwhelming selling pressure. Seeing a Maribozu is like hearing someone shout a single word with absolute conviction. There's no ambiguity. Now let's look at the polar opposite, the doji. The doji is the candle of pure indecision. It looks like a cross or a plus sign. It has a very, very thin body, sometimes just a line, meaning the opening and closing prices were almost identical. But it often has long upper and lower wicks. What story does this tell? It tells the story of an epic battle that ended in a stalemate. During that period, the buyers pushed the price way up. The sellers fought back and dragged the price way down. They went back and forth, a furious tug of war. But by the end of the session, neither side had gained any ground. They ended right back where they started. A doji signals a pause, a moment of reflection in the market. The trend, whether up or down, has run into a wall of uncertainty. It's the market taking a deep breath, and traders pay close attention to what happens next, because after a stalemate, one side is likely to make a decisive move. So we have control with the Maribozu and indecision with the doji. But most of the time, the market story is more nuanced. It's a conversation that unfolds over multiple candles. This is where two candle patterns come in, and one of the most significant is the engulfing pattern. An engulfing pattern is exactly what it sounds like. It's when one candle's body completely swallows or engulfs the body of the previous candle. This is a powerful reversal signal, suggesting the momentum is about to make a U-turn. Let's imagine a currency pair has been in a downtrend. You see a series of red candles, each one closing lower than the last. The sellers are in control. The mood is pessimistic. Then a small red candle forms. The sellers are still pushing, but maybe with less force. And then the next candle happens. It opens lower than the previous day's close, a classic sign of bearish continuation. But then something shifts. The buyers storm in with incredible force. They push the price up, not just past the previous candle's open, but all the way past its high, closing significantly above it. This new large green candle has completely engulfed the previous small red candle. This is a bullish engulfing pattern. It's a dramatic story. It's like watching a football game where one team is driving down the field, and suddenly the quarterback throws an interception, and the other team runs it all the way back for a touchdown. The entire momentum of the game has just flipped in a single play. The bullish engulfing pattern suggests that the sellers have lost control, and the buyers have seized power with overwhelming force. It's a potential sign that the downtrend is exhausted, and an uptrend could be starting. The opposite is the bearish engulfing pattern. Picture an uptrend. Green candles are marching upwards, optimism is high. A small green candle forms, and then the next candle opens higher, starting the day with that same optimism. But then the sellers show up. They slam the price down, erasing all the day's gains, pushing it below the previous candle's open, and closing well below it. This huge red candle has now engulfed the prior green one. The story here is one of a sudden and brutal rejection of higher prices. The buyer's party came to an abrupt end. This pattern suggests the uptrend may be over, and a downtrend could be on the horizon. It's the market hitting a brick wall at full speed. These engulfing patterns are so closely watched because they represent a clear and dramatic shift in market psychology. It's not just a small change. It's a complete reversal of sentiment within a single trading period. Now let's look at another pair of patterns that tell a similar story of reversal, but in a different way. The hammer and the hanging man. They look identical, but their meaning depends entirely on where you find them. Both have a short body at the top and a long lower wick that's at least twice the size of the body. There's little to no upper wick. Imagine a downtrend. Prices are falling. Then, a candle forms where the sellers initially push the price way down, creating that long lower wick. But before the session closes, the buyers stage a heroic comeback. They push the price all the way back up so it closes near where it opened. This candle, appearing at the bottom of a downtrend, is called a hammer. Why? because it looks like the market is trying to hammer out a bottom. The long lower wick shows a powerful rejection of lower prices. The sellers tried to push it down, but the buyers said no and hammered it right back up. It's a sign of potential bullish reversal. Now take that exact same shaped candle, small body on top, long wick on the bottom, and place it at the top of an uptrend. Now it's called a hanging man. The story it tells is much more ominous. During an uptrend, this candle shows that for the first time, sellers were able to push the price significantly lower during the session. Even though the buyers managed to push it back up by the close, that long lower wick is a warning sign. It shows that significant selling pressure emerged where there was none before. It's like seeing a crack appear in a dam. The water is still being held back, but it's a signal that the structure's integrity might be failing. The hanging man suggests that the buying momentum is weakening, and the uptrend could be nearing its end. So you have the same visual shape telling two completely different stories based on the context of the preceding trend. This is a critical lesson in reading charts. Context is everything. A single candle or pattern is meaningless in isolation. It only gains its meaning from the story that came before it. Understanding the Marubozu, the doji, the engulfing patterns, and the hammer and hanging man gives you a foundational vocabulary. You can now start to decipher the basic sentences the market is writing, identifying moments of clear control, total indecision, and dramatic shifts in power. But these are just 1 and 2 candle phrases. What happens when the market forms more complex 3-part sentences? What happens when a whole group of candles work together to tell a story of a slow, methodical shift in power, rather than a sudden reversal? That's when we start to see patterns that can signal longer-term changes, and understanding those is the next step in becoming fluent in the language of the charts. These patterns are the market's body language. While a single candlestick might be a word, a chart pattern is a full sentence, even a paragraph, revealing the collective psychology of millions of traders around the world. It's a visual story of a battle between buyers, the bulls, and sellers, the bears. And understanding these stories is what separates a novice from someone who can truly read the market's intentions. Think about it. These shapes on your screen aren't random squiggles. They are formed by human emotions. Greed pushing prices higher, fear causing sell-offs, and indecision creating a sideways grind. When these emotions play out on a massive scale, they create repeatable formations. Our job is to learn to recognize them. Broadly, these patterns fall into 2 main categories: reversal patterns, which suggest a trend is about to change direction, and continuation patterns, which suggest a trend is just taking a breather before continuing on its way. Let's start with the heavy hitters, the reversal patterns. These are the ones that can signal a major shift in the market's tide. Perhaps the most famous of all is the head and shoulders pattern. It sounds a little strange, but once you see it, you'll never forget it. Imagine a strong uptrend. The price rallies to a peak, then pulls back. That's the left shoulder. Then the buyers push even harder, driving the price to a new, higher peak before it pulls back again. That's the head. Finally, the buyers try one more time, but their energy is fading. They manage a small rally, but it fails to reach the height of the head, and it falls back down again. That's the right shoulder. If you connect the low points of those 2 pullbacks, you create what's called the neckline. The story this pattern tells is one of exhaustion. The bulls gave it 3 shots, with the second one being their absolute best effort. The third attempt was weak, a sign that they were running out of steam. The bears are sensing this weakness. The critical moment is when the price breaks below that neckline. This is seen by many as the confirmation. It's like a dam breaking. The support that was holding the price up has failed, and it often signals the potential start of a new downtrend. And of course, this works in reverse. At the bottom of a downtrend, you can see an inverse head and shoulders, which looks like the same pattern flipped upside down, and a break above its neckline can signal that the bears have lost control and a new uptrend could be starting. Next up, we have the double top and double bottom. These are a bit simpler but just as powerful. A double top looks like the letter M. The price rises to a peak, pulls back, and then rallies again to roughly the same level as the first peak, but fails to break through. It hits a ceiling, a powerful level of resistance. The story here is clear. Buyers tried to push past a certain price point, were rejected, regrouped, tried again, and were rejected a second time. That second failure is a huge psychological blow to the bulls. It shows the sellers are firmly in control at that price level. The pattern is typically considered confirmed when the price breaks below the low point between the 2 peaks. The double bottom is its bullish twin, looking like the letter W. At the end of a downtrend, the price hits a low, bounces, falls back to test that same low again, and holds. That floor, that support level has been tested twice and proven strong. It tells us the sellers tried to push the price lower, but the buyers stepped in with force not once but twice. A break above the peak between the two bottoms can signal that the sellers are exhausted and the buyers are now in control. Now, what about when the market isn't changing its mind but just catching its breath? That's where continuation patterns come in. These signal that the prevailing trend is likely to resume after a brief pause. Think of flags and pennants. These are short-term patterns that often appear after a very strong, sharp move in price. That initial sharp move is called the flagpole. After this big move, the price will consolidate. It might drift sideways or slightly against the trend in a tight, rectangular shape. That's a flag. Or it might coil into a tiny symmetrical triangle. That's a pennant. The psychology here is one of profit-taking and re-entry. After a huge move, some traders take their profits, causing the price to pause. But other traders who missed the initial move see this pause as their chance to jump in the direction of the trend. So the market takes a quick breather, gathers its strength, and then often breaks out of the flag or pennant to continue the original powerful move. It's like a sprinter in the middle of a 100-meter dash taking a single quick breath before exploding again toward the finish line. For a longer pause, we have triangles. These show a more drawn-out battle between buyers and sellers before the trend resumes. There are three main types. First, the symmetrical triangle. This is formed when you have a series of lower highs and higher lows. The price range gets tighter and tighter, coiling like a spring. It represents pure indecision. Neither the buyers nor the sellers can gain the upper hand. But everyone knows this coiling can't last forever. A breakout is coming. While it's technically a continuation pattern, a symmetrical triangle can break out in either direction, though many traders look for it to resolve in the direction of the preceding trend. The tension builds and builds until one side finally wins and the price explodes out of the triangle. Then there's the ascending triangle. This is a bullish pattern. You see a flat, horizontal resistance level at the top. The sellers are holding the line at a specific price. But below that, you see a series of higher lows. The buyers are getting more and more aggressive, willing to pay more each time the price dips. They are relentlessly pushing up against that ceiling of sellers. The story is one of building pressure from below. Eventually, if that pressure continues, the ceiling might break, leading to a strong upward move. The opposite is the descending triangle, a bearish pattern. Here you have a flat support level at the bottom. The buyers are defending a specific price. But from above, you see a series of lower highs. The sellers are getting more aggressive, pushing the price down with more force on each rally. The pressure is building from above, squeezing the price against that floor of support. If that floor gives way, it can lead to a significant drop. Now, there is one absolutely critical piece of information that makes all of these patterns more reliable. Volume. Volume represents the number of shares or contracts traded. It's the fuel behind the move. It tells you how much conviction is behind a price change. A pattern that forms on low, dwindling volume is less significant. But a breakout from a pattern, whether it's the neckline of a head and shoulders or the edge of a triangle, that occurs on a huge spike in volume, that's the market shouting, not whispering. It shows a massive number of participants are rushing in, confirming the new direction with their capital. A breakout without volume is suspect. A breakout with high volume demands your attention. It's crucial to remember. These patterns are not magical formulas. They are tools of probability, not certainty. They can fail. A beautiful-looking flag pattern can suddenly break in the wrong direction. A textbook head and shoulders might see its neckline hold as support. The goal isn't to find a pattern and blindly place a trade. The goal is to use these patterns as part of a larger analysis, to understand the story the market is telling about the struggle between buyers and sellers, and to identify key levels where that struggle might be resolved. They provide context and a framework for developing a hypothesis about where the price might go next. We've learned to read the individual words with candlesticks, and now the sentences with chart patterns. We are seeing the ebb and flow of market psychology take shape on the screen. But what if there was a way to measure the strength of these bulls and bears, to put a number on their momentum and quantify the power of a trend? What if we could overlay tools onto our charts that help us smooth out the noise and clarify the bigger picture? That's where we bring in the heavy artillery, technical indicators. And these indicators aren't mystical crystal balls. Think of them more like the dashboard of a high-performance vehicle. The raw price chart, the candlesticks, that's you looking out the windshield. You can see the road ahead, you can see the turns. But the dashboard gives you critical data. Your speed, your engine RPM, your fuel level. Technical indicators are the trader's dashboard. They take the raw price data and process it into a more digestible format, helping you measure the market speed, its momentum, and its potential direction. Let's start with the most fundamental and widely used indicator on the planet, the moving average. The name says it all. It calculates the average price of a currency pair over a specific number of periods, say the last 50 days. By doing this, it smooths out the day-to-day price fluctuations, the noise, and gives you a clearer flowing line that reveals the underlying trend. Imagine you're tracking daily temperatures in your city. One day it's 75, the next it's 68, then 78. It's choppy, but if you take the average temperature over the last 30 days, you get a much smoother line that clearly shows you whether you're heading into summer or winter. That's a moving average. There are two main flavors you'll encounter. The first is the simple moving average, or SMA. It's the most straightforward. It adds up the closing prices for a set number of periods and then divides by that number. For a 20-day SMA, it treats the price from 20 days ago with the exact same importance as the price from yesterday. It's a true simple average. The second is the exponential moving average, or EMA. This one is a bit more sophisticated. The EMA also calculates an average, but it gives more weight to the most recent prices. It argues that what the market did yesterday is more relevant to today than what it did a month ago. Because of this, the EMA reacts more quickly to recent price changes than the SMA. There's no better one. They're just different tools for different jobs. Some traders prefer the smoothness of the SMA to identify long-term trends, while others prefer the responsiveness of the EMA for shorter-term analysis. So, how do traders actually use these lines on a chart? The most basic way is to determine the general trend. If the price is consistently trading above a key moving average, like the 50-day or 200-day moving average, it's a general signal that the market is in an uptrend. Conversely, if the price is trading below it, the underlying trend may be down. It acts as a dynamic, curving line of support or resistance. In a strong uptrend, you'll often see the price pull back to touch the moving average before bouncing off it and continuing higher. Another popular technique is the moving average crossover. This involves plotting two moving averages on your chart, a shorter-term one like a 50-day, and a longer-term one like a 200-day. When the shorter-term moving average crosses above the longer-term one, it's known in the stock market world as a golden cross, a signal that has historically been associated with the potential start of a new bull run. When the short-term MA crosses below the long-term MA, it's called a death cross, signaling a potential downtrend. Now, these are just observations of historical patterns, not future guarantees, but they are significant events that many market participants watch closely. Moving averages are fantastic for identifying the direction of the trend. But what about its strength? Its momentum? Is the trend running out of steam? Or is it just getting started? For that, we turn to a different class of indicators called oscillators. And the king of oscillators is the Relative Strength Index, or RSI. The RSI doesn't look at the average price. It looks at the speed and magnitude of recent price changes. Think of it as the market speedometer. It's plotted on a scale from 0 to 100. The RSI tells you how strongly a currency pair has been moving in one direction. Typically, readings above 70 are considered overbought, and readings below 30 are considered oversold. Now, this is one of the biggest traps for new traders. They see RSI go above 70 and they think, it's overbought, time to sell. Or it drops below 30 and they think, it's oversold, time to buy. This can be a costly mistake. A market can remain overbought for a very long time in a powerful uptrend. Think of a freight train. Just because it's moving fast doesn't mean it's about to stop and reverse. It can keep going at high speed for miles. So, a more nuanced way to use the RSI is not as a simple buy or sell signal, but as a way to measure momentum. For example, if a currency pair is in an uptrend confirmed by a moving average, a trader might wait for the RSI to dip down from overbought territory, or even toward the 50 midline, as a potential sign of a temporary pullback before entering in the direction of the main trend. But the real power of RSI, and where it starts to feel like a superpower, is a concept called divergence. This is when the indicator starts telling a different story than the price itself. Let's say the price of the euro to US dollar makes a new high. The chart is clearly going up, but when you look down at your RSI indicator, you see that it failed to make a new high. It actually made a lower high. This is called bearish divergence. What is this telling you? It's a potential warning sign. The price is still climbing, but the momentum, the force behind that climb, is weakening. It's like a quarterback throwing the ball farther and farther down the field, but each throw has a little less velocity, a little less power behind it. It suggests the upward trend might be losing steam and could be due for a reversal or a significant pullback. The opposite is also true. If the price makes a new low, but the RSI makes a higher low, that's bullish divergence. It suggests that even though sellers are pushing the price down, the downward momentum is fading, and the bulls might be getting ready to take back control. Divergence isn't a foolproof signal, but it's an incredibly powerful concept that alerts you to a potential change in the market dynamic before it becomes obvious on the price chart itself. So we have moving averages to help us identify the trend, our market's GPS. And we have the RSI to measure momentum, our market speedometer. The key is that these tools are rarely used in isolation. World-class pilots don't just stare at a single instrument on their control panel. They scan across their altitude, airspeed, and heading to build a complete picture of the situation. Similarly, traders often build a system by combining indicators that complement each other. You might use a long-term moving average like the 200-day EMA to define the overall trend. Your rule could be, if the price is above the 200 EMA, I'm only looking for buying opportunities. If it's below, I'm only looking for selling opportunities. Then you could use a shorter-term tool like the RSI to time your entry. Within that major uptrend, you might wait for the price to pull back and for the RSI to show bullish divergence, suggesting the pullback is losing steam and the primary trend is about to resume. By combining these indicators, you move from simply reacting to price movements to proactively analyzing the market's underlying structure. You're no longer just watching the waves on the surface. You're starting to understand the currents underneath. You're adding layers of confirmation to your analysis, building a more robust case for why a particular move might happen. But how do we take this a step further? How do we combine these powerful indicators with the raw price patterns we discussed earlier, the head and shoulders, the triangles, the flags? How does a moving average acting as support change the interpretation of a double bottom pattern? That's where the art and science of technical analysis truly begin to merge. It's the question that separates the novice from the developing analyst. And the answer lies in a single powerful concept: confluence. Confluence is the idea that the most compelling trading signals occur when multiple, independent analytical tools all point to the same conclusion. It's like getting a second, third, and fourth opinion on a diagnosis, all from different specialists, and they all agree. When a classic chart pattern, a key support level, and an indicator all scream the same message, analysts pay very close attention. This is about stacking the probabilities in your favor, based on historical chart behavior. It's not about finding a magic bullet. It's about building a compelling case. And the first piece of evidence we need to add to our case is perhaps the most fundamental, yet most overlooked indicator on any chart: volume. If price is the what, then volume is the how much. It represents the amount of conviction behind a price move. On a stock chart, volume is simple. It's the number of shares traded. In the decentralized Forex market, it's a bit different. What you typically see labeled as volume on a Forex chart is actually tick volume. It measures how many times the price has ticked up or down in a given period. While not a perfect measure of the actual currency units being traded, it serves as an excellent proxy for trading activity and interest. Think of it as the roar of the crowd at a stadium. A quiet murmur suggests disinterest, while a deafening roar signals intense engagement. So how do we interpret this roar? First, look for confirmation. Let's say you spot a bullish flag pattern, and the price breaks out to the upside. If that breakout happens on a massive spike in volume, that's confirmation. It suggests a large number of market participants are aggressively buying, supporting the move higher. Conversely, if the price breaks out on weak, anemic volume, it's a red flag. It's like a car trying to accelerate without any gas in the tank. Such moves have a higher historical tendency to fail and reverse, what analysts call a fake-out. Volume also tells a story during a trend. In a healthy, strong uptrend, you typically want to see volume increase as the price rises and decrease as the price pulls back. This pattern suggests that the conviction is with the buyers. When the price goes up, the crowd roars. When the price dips a little, the crowd quiets down, showing a lack of interest in selling. If you start to see the opposite, volume drying up on the up moves and spiking on the down moves, it could be an early warning sign that the trend is losing its steam. Let's apply this to our chart patterns. Remember the head and shoulders pattern? A classic signal of a potential trend reversal. Volume can add a crucial layer of confirmation. Typically, the volume on the left shoulder is high. Then, the volume on the head is often a bit lower even though the price makes a new high, our first hint of divergence. Finally, the volume on the right shoulder is usually even weaker. The lack of buying interest is becoming more and more apparent. The final piece of the puzzle is the breakout. When the price breaks below the neckline, a huge spike in selling volume would be the powerful confirmation that analysts look for. It's the market shouting that the bears are now in control. Volume is our foundation for confirmation. Now let's add a different type of tool to our kit. A tool designed to measure momentum. We're moving into the world of oscillators. Oscillators are indicators that are plotted above or below a price chart, and they typically fluctuate between two extremes or around a center line. They help us gauge the speed and health of a price move, and they can be invaluable for identifying potential overbought or oversold conditions. One of the most popular and effective oscillators used by traders worldwide is the Relative Strength Index, or RSI. The RSI is a momentum oscillator that measures the speed and change of price movements on a scale of 0 to 100. Don't worry about the complex math behind it. What you need to understand is what it's telling you. The RSI helps answer the question, how fast and how far has the price moved recently? Traditionally, the RSI is considered overbought when it's above 70 and oversold when it's below 30. Now, this is one of the most misunderstood concepts in technical analysis. For a beginner, it's incredibly tempting to see the RSI cross above 70 and think, it's overbought, I have to sell. Or to see it dip below 30 and think, it's oversold, time to buy. This is a trap. In a strong uptrend, the RSI can stay in the overbought territory for a very long time as the price continues to climb higher and higher. And in a brutal downtrend, it can stay oversold for weeks. So, thinking of these levels as automatic buy or sell signals is a flawed approach. Instead, think of them as alerts. An RSI reading above 70 tells you that the upward momentum has been very strong, and the market might be getting a bit extended. It's a signal to be cautious, to look for other signs of weakness, not to blindly short the market. An RSI reading below 30 tells you that selling has been aggressive, and a bounce could be on the horizon. But it doesn't mean the downtrend is over. The real power of the RSI, and where it truly starts to merge with our price action analysis, is through a concept called divergence. This is a bit more advanced, but it's a game changer for understanding market dynamics. Divergence occurs when the price and the oscillator tell two different stories. There are two main types. First, bullish divergence. This happens when the price on your chart makes a new low, but the RSI makes a higher low. Think about what that means. The price has fallen further, but the momentum behind that new low is weaker than it was on the previous low. The sellers are getting exhausted. It's like a boxer throwing punches in the final round. The punches are still landing, but they've lost their power. This divergence is a potential early warning sign that the downtrend might be losing steam, and a reversal to the upside could be coming. Second, we have its opposite, bearish divergence. This is when the price on your chart makes a new high, but the RSI makes a lower high. The price has pushed to a new peak, but the momentum behind that push is weaker than before. The buyers are running out of breath. This is a classic warning sign that the uptrend may be nearing its end. Now let's bring it all together. Let's build a case using confluence. Imagine you're looking at the chart of the US dollar versus the Japanese yen, the US dollar to Japanese yen. You notice the price has been in a strong uptrend but is now approaching a major resistance level that you identified on your chart, a level where price has turned back several times in the past. As the price pushes up and makes a new high, you glance down at your RSI. You see it. The price made a higher high, but the RSI has made a lower high. Bearish divergence. That's your first piece of evidence. You then look at the price action itself. As the price hit that resistance level, it formed a bearish engulfing candlestick pattern. A big red candle that completely swallows the previous green candle. That's your second piece of evidence. The price action itself is signaling a potential reversal. Finally, you look at your volume indicator. The volume on that last push to the new high was noticeably lower than the volume on the previous high. The conviction wasn't there. But on the big red bearish engulfing candle, you see a significant spike in volume. The sellers showed up with force. That's your third powerful piece of evidence. Do you see it now? You have a major resistance level. You have a bearish candlestick pattern. You have bearish divergence on your momentum oscillator. And you have volume confirming the weakness of the buyers and the strength of the sellers. No single signal is a guarantee, but together they build a compelling high-probability case based on historical analysis that the trend may be about to reverse. This isn't about predicting the future. It's about reading the present evidence on the chart to understand the balance of power between buyers and sellers. This is the art and science of technical analysis in action. And we're just getting started. There are other categories of indicators that can give us even more insight into market structure and potential turning points. So, if trend and momentum indicators tell us about the direction and speed of the market, what else is there? Imagine you're planning a sailing trip. Knowing the direction of the wind and the speed of the current is critical. But there's another piece of information that's just as important. Are the seas calm and glassy, or are they choppy and violent? This is the concept of volatility. Volatility indicators don't necessarily tell you which way the price is headed, but they tell you about the character of the market's movement. They measure the size of the price swings. A low volatility market is like a calm river, gently flowing. A high volatility market is like raging rapids, unpredictable and powerful. Understanding this state is crucial for managing risk and identifying potential breakout opportunities. The most famous volatility indicator, one you'll see on charts everywhere, is called Bollinger Bands. It was developed by a trader named John Bollinger, and its genius lies in its simplicity and dynamic nature. Unlike static lines of support and resistance, Bollinger Bands adapt to the market's mood in real time. They consist of 3 lines plotted over the price chart. The middle line is just a simple moving average, typically a 20-period one, which acts as our baseline for the trend. The real magic is in the 2 outer bands. These bands are placed a certain number of standard deviations, a statistical measure of variance, above and below the middle moving average. Don't let the term standard deviation intimidate you. All it really means is that these outer bands will automatically expand when the market is volatile and contract when the market is calm. They create a dynamic envelope around the price. So how do we use this? The most classic signal from Bollinger Bands is something called the squeeze. This is when you see the upper and lower bands tighten, moving closer together. It looks like the price is being squeezed into a narrow channel. This is a sign of extremely low volatility. But here's the thing about markets. Periods of low volatility are almost always followed by periods of high volatility. A Bollinger Band squeeze is like a coiled spring. The market is building up energy, consolidating, preparing for a big move. The squeeze itself doesn't tell you if the price will break out to the upside or the downside, but it tells you to pay attention. It's the market's way of whispering, something is about to happen. When the price finally does break out of that tight squeeze with force, it can often signal the start of a powerful new trend. Conversely, when the bands are very far apart, it signals high volatility. The market is stretched. This can sometimes indicate that a trend might be overextended and due for a pause or a reversal. Another key observation is how the price interacts with the outer bands. In a very strong uptrend, you'll often see the price walking the band, meaning the candlesticks will repeatedly touch or ride along the upper Bollinger Band. This isn't a signal to sell. On the contrary, it's a sign of immense strength and momentum. The same is true in a downtrend when the price walks the lower band. It shows the trend is powerful and sustained. Bollinger Bands give us context. They frame the price action, telling us if the current move is aggressive or quiet, helping us anticipate major shifts in market energy. Now, let's add another crucial dimension to our analysis. We've talked about trend, momentum, and volatility. But what about participation? What if a stock price moves up by $1? Does it matter if one person bought it or if a million people bought it? Absolutely. This is the concept of volume. Volume represents the number of shares or contracts traded over a specific period. It's the fuel behind the price move. It's the crowd's footprint. High volume tells you there's a lot of conviction, a lot of participation behind a price move. Low volume suggests a lack of interest, making the price move less significant and potentially less reliable. On most charting platforms, volume is shown as a series of vertical bars at the bottom of the screen, typically colored green if the price closed up for the period and red if it closed down. The height of the bar shows the amount of volume. The key is to analyze volume in relation to price action. Let's say a currency pair has been in a range, and it suddenly breaks out above a key resistance level. If that breakout happens on a huge spike in volume, it tells you that a large number of market participants agree with this new higher price. It validates the move. It suggests the breakout has strength and is more likely to continue. On the other hand, if the price breaks out on very low, anemic volume, it's a red flag. It's like one person shouting in an empty stadium. It's not very convincing. That breakout might be false, a trap designed to lure in unsuspecting traders before the price reverses. Volume is also incredibly powerful for spotting potential trend exhaustion. Imagine a long sustained uptrend. For months, the price has been making higher highs and higher lows. But then you notice something. The price makes a brand new high, pushing into new territory, but the volume on that move is significantly lower than the volume on the previous high. This is called a divergence. Price is going up, but the participation, the conviction, is drying up. This is a warning sign that the trend might be running out of steam. The smart money might be quietly distributing their positions, and the trend could be nearing a top. Volume helps us peek behind the curtain of price and gauge the true sentiment of the market. It's the difference between hearing a rumor and seeing the crowd itself start to run. So now we have these incredible tools. We have moving averages to define the trend. We have RSI and MACD to measure momentum. We have Bollinger Bands to gauge volatility. And we have volume to confirm conviction. The beginner's mistake is to look for one perfect indicator that will tell them when to buy and sell. The professional approach is to look for confluence. Confluence is a beautiful concept. It's when multiple, non-correlated indicators all start pointing to the same conclusion. It's about building a case, like a detective gathering different pieces of evidence. Let's walk through a hypothetical scenario on the Euro to US dollar chart. Let's say we notice the price is trading above its 50-day and 200-day moving averages. Evidence piece number 1. The long-term trend appears to be up. Then we look at our momentum oscillators. We see the MACD line has just crossed above its signal line, and the RSI has crossed above 50, showing that bullish momentum is building. Evidence pieces 2 and 3. Now we add our volatility indicator. We see that the price has just broken out of a tight Bollinger Band squeeze, and it's starting to push against the upper band with expanding volatility. Evidence piece number 4. The market is waking up with energy to the upside. Finally, we look down at the bottom of our chart. We see that this breakout is accompanied by a significant spike in volume, much higher than the average volume over the past few weeks. Evidence piece number 5. There is strong conviction behind this move. Do you see how much more powerful that is than just one signal? We have the trend, momentum, volatility, and volume all aligning, all telling a similar story. This is confluence. It doesn't mean the trade is a sure thing, nothing ever is. But it dramatically increases the probability that you're on the right side of the market. It's about stacking the odds in your favor by confirming your analysis across different dimensions of market activity. This is the essence of using technical indicators effectively. They are not a crystal ball. They are lenses, each providing a unique perspective on the complex battle between buyers and sellers. By combining these perspectives, we can begin to see a much clearer, more complete picture of what is truly happening on the chart. But what if I told you that the price itself, without any of these mathematical overlays, forms predictable shapes and patterns that reveal the market's next potential move? These are the hidden stories etched into every chart, the psychological footprints of the crowd, and in the next part we're going to learn how to read them. These patterns are the market's body language. They are recurring shapes formed by price movements that can help us anticipate what might happen next. Think of them not as guarantees, but as historical roadmaps. When you see a formation that has historically led to a specific outcome 70% of the time, you're not looking at a crystal ball, you're looking at a probability. You're stacking the deck in your favor by understanding the collective psychology of traders, visualized right there on your screen. These patterns fall into two major categories: continuation patterns and reversal patterns. It's exactly what it sounds like. Continuation patterns suggest the market is just taking a breather before continuing in its current direction. Reversal patterns, on the other hand, signal that the trend might be running out of steam and is about to change course. Let's start with the breathers, the continuation patterns. One of the most common you'll see is the flag. Imagine a stock or a currency pair is in a strong uptrend. The price shoots up aggressively. This sharp, nearly vertical move is called the flagpole. But nothing goes up in a straight line forever. The market needs to consolidate. Buyers take some profits, new sellers test the waters. During this period, the price drifts slightly downwards or sideways, contained within two parallel lines, forming a small, tilted rectangle that looks like a flag hanging off the pole. This is a bullish flag. It represents a temporary pause. The key is to watch for the price to break out of the top of that flag pattern. When it does, it often signals that the consolidation is over, and the original uptrend is ready to resume, often with another strong move. The same logic applies in reverse for a bear flag in a downtrend. A sharp drop, a slight upward consolidation, and then a potential continuation of the downward move. Very similar to a flag is a pennant. It starts the same way with a sharp move up or down the flagpole. But instead of forming a rectangular flag, the consolidation period sees the price bounce between two converging trend lines, forming a tiny symmetrical triangle, a pennant. This shows a period where the trading range gets tighter and tighter. The tension is building. Like a coiled spring, the expectation is that the price will eventually break out of the pennant and continue in the direction of the original flagpole. Both flags and pennants are short-term patterns, representing brief interruptions in a powerful trend. Another powerful continuation pattern is the rectangle. This happens when the price bounces back and forth between a clear horizontal support level and a horizontal resistance level. It looks like a box or a channel on your chart. This pattern signifies a major tug-of-war between buyers and sellers. Neither side can gain control. It's a period of pure consolidation and indecision. For traders looking for continuation, the strategy is to wait. You wait for the price to decisively break out of the box. If the preceding trend was up, a breakout above the rectangle's resistance suggests the bulls have won the battle, and the uptrend is likely to continue. If the preceding trend was down, a breakdown below the rectangle's support suggests the bears are back in control. Now let's talk about the game changers, the reversal patterns. These are the patterns that can signal a major shift in market direction. The undisputed king of reversal patterns is the head and shoulders. This pattern typically forms at the peak of an uptrend and suggests a potential turn from bullish to bearish. It's composed of three peaks. The price rallies to a peak and then pulls back. That's the left shoulder. Then it rallies to an even higher peak before pulling back again. That's the head. Finally, it rallies one more time, but to a lower peak than the head, and pulls back again. That's the right shoulder. If you draw a line connecting the low points of the two pullbacks, you get what's called the neckline. The psychology here is powerful. The left shoulder and the head show a healthy uptrend, but the right shoulder's failure to make a new high is the first major warning sign. It shows the buyers are losing steam. The definitive signal, however, is when the price breaks below that neckline. A decisive close below the neckline is seen by many analysts as confirmation that the uptrend is over, and a new downtrend may be starting. Of course, what goes up can also go down, and the market has a mirror image of this pattern for the bottom of a downtrend. It's called the inverse head and shoulders. It's the same structure, just flipped upside down. You have a trough, left shoulder, a lower trough, the head, and then a higher trough, the right shoulder. The neckline connects the highs of the bounces in between. A break above this neckline suggests that the downtrend is exhausted, and a new uptrend could be underway. Next up are two other classic reversal patterns: the double top and the double bottom. A double top looks like the letter M. It occurs after an extended uptrend. The price hits a resistance level, pulls back, and then rallies back to that same resistance level again but fails to break through. This second failure to push higher is a strong indication that the buying pressure is waning. The sellers are defending that price level fiercely. The pattern is considered confirmed when the price breaks below the support level formed by the low point between the two peaks. It's a clear signal that the sellers have taken control. The double bottom is its bullish counterpart, looking like the letter W. It forms at the end of a downtrend. The price falls to a support level, bounces up, then falls back to test that same support level again. The inability to break lower on the second attempt shows that the selling pressure is drying up. Buyers are stepping in to defend that level. The reversal is confirmed when the price breaks above the resistance level formed by the peak between the two bottoms. This suggests a potential shift from a downtrend to an uptrend. Now here's the most important part. Identifying these patterns is one thing, using them effectively is another. First, confirmation is everything. A pattern is just a potential pattern until it's confirmed. A head and shoulders is just 3 bumps on a chart until the price breaks the neckline. A rectangle is just a sideways market until the price breaks out. Acting before confirmation is a high-risk proposition. Second, pay attention to volume. Volume can be a fantastic confirmation tool. In a healthy breakout from a continuation pattern, you typically want to see a surge in volume. It shows conviction behind the move. In a head and shoulders pattern, you might see volume decreasing on each successive peak, indicating fading enthusiasm for the uptrend, which adds more weight to the potential reversal. Finally, and this is crucial, context is king. A pattern doesn't exist in a vacuum. A bullish reversal pattern like a double bottom is far more significant if it forms at a major, long-term support level that you've already identified on a higher time frame. A bearish flag is more reliable if it forms within a well-established, long-term downtrend. You must combine pattern recognition with the other concepts we've discussed: like trend analysis and support and resistance. They all work together to paint a more complete picture of the market. By learning to see these shapes, you're no longer just looking at random squiggly lines. You're starting to interpret the narrative of the market, the battles between buyers and sellers, the moments of indecision, and the crucial turning points. But what if we could add another layer to this analysis? What if, on top of reading these visual stories, we could apply mathematical formulas to the price action itself, to measure momentum, identify trend strength, and spot overbought or oversold conditions with more precision? That's exactly what technical indicators allow us to do, and they are the next critical piece of the puzzle we're going to put together. Think of technical indicators as specialized instruments in a mechanic's toolbox. While you can tell a lot about a car just by looking at it and listening to the engine, that's our price action and chart patterns, these tools allow you to look deeper. They help you measure things you can't see with the naked eye, like the engine's compression or the battery's voltage. Indicators are mathematical calculations based on a currency pair's price, volume, or other factors. They are plotted on the chart, usually as a line or a set of lines, and they provide a different perspective on the price action. The most important thing to understand is this: indicators are derivatives of price. They are not crystal balls. They simply process past price data in a different way to give us clues about trend, momentum, and volatility. Let's start with the most fundamental and widely used category: trend following indicators, specifically moving averages. A moving average, or MA, does exactly what its name implies. It calculates the average price of a currency pair over a specific number of periods, like the last 20 days or the last 50 hours. By doing so, it smooths out the day-to-day price fluctuations and gives you a clearer view of the underlying trend. It's like looking at a coastline from a satellite instead of standing on the beach getting hit by individual waves. You see the overall shape much more clearly. There are two main types you'll encounter. The first is the simple moving average, or SMA. It's the most basic form. It just adds up the closing prices for a certain number of periods and divides by that number. For example, a 20-day SMA is the average closing price of the last 20 days. The second type is the exponential moving average, or EMA. The EMA is a bit more sophisticated. It also calculates an average, but it gives more weight to the most recent prices. This makes it react more quickly to new price information. Neither is inherently better, they just serve different purposes. A trader looking for a smoother, long-term trend view might prefer an SMA, while someone focused on shorter-term moves might opt for an EMA. So, how do traders use them? The most basic application is to identify the trend's direction. If the price is consistently trading above a key moving average, like the 50-period or 200-period MA, it's generally considered to be in an uptrend. If it's trading below, it's often seen as a downtrend. These moving averages can also act as dynamic levels of support and resistance. In a strong uptrend, you'll often see the price pull back to a moving average, bounce off it, and continue higher. It's as if the average is providing a flexible floor for the price. Another common technique is looking for moving average crossovers. This involves plotting two moving averages on your chart, a shorter-term one like a 50-period MA, and a longer-term one like a 200-period MA. When the shorter-term MA crosses above the longer-term MA, some analysts view this as a potential signal of a new uptrend beginning. In stock market circles, this is often called a golden cross. Conversely, when the shorter-term MA crosses below the longer-term MA, it can be interpreted as a sign of a potential new downtrend, an event sometimes referred to as a death cross. It's crucial to see these not as direct commands to buy or sell, but as confirmations that the market's underlying momentum might be shifting. While moving averages are great for identifying trends, they don't tell you much about the strength or speed of that trend. For that, we turn to our next category: momentum indicators, also known as oscillators. These indicators typically move back and forth between a set range of values, and they help us gauge if a market is overbought or oversold. The king of momentum oscillators is the Relative Strength Index, or RSI. The RSI measures the speed and change of price movements on a scale of 0 to 100. It essentially compares the magnitude of recent gains to recent losses to determine if a currency pair is being overbought or oversold. Traditionally, a reading above 70 is considered overbought, and a reading below 30 is considered oversold. Now, this is where many beginners make a huge mistake. Overbought does not automatically mean sell, and oversold does not automatically mean buy. A market can remain in an overbought condition for a very long time during a powerful uptrend, and vice versa. Think of it more like a rubber band. When the RSI is above 70, the rubber band is stretched tight. Good snapback, but it could also just stay stretched for a while. A more nuanced way to use the RSI is to look for something called divergence. Divergence occurs when the price is doing one thing, but the indicator is doing the opposite, suggesting that the momentum behind the price move is fading. For example, let's say the price of euro to US dollar makes a new higher high, but the RSI makes a lower high. This is called bearish divergence. It's a potential warning sign that the upward momentum is weakening, and the trend might be due for a pullback or a reversal. Conversely, if the price makes a new lower low, but the RSI makes a higher low, that's bullish divergence. It suggests that even though the price is falling, the selling pressure is losing steam, and a potential bounce could be on the horizon. Divergence is a powerful concept because it can give you an early heads up that the trend you're watching might be running out of gas. Our third and final category of indicators helps us understand market volatility. Volatility is simply the degree of variation of a trading price series over time. Is the market calm and quiet, or is it wild and chaotic? For this, many traders turn to Bollinger Bands. Bollinger Bands consist of 3 lines plotted on the chart. The middle line is typically a 20-period simple moving average. The upper and lower bands are then placed 2 standard deviations away from this middle line. Standard deviation is just a statistical measure of how spread out the prices are. What this creates is a dynamic channel that the price tends to stay within about 95% of the time, statistically speaking. The most obvious feature of Bollinger Bands is how they behave in relation to volatility. When the market is quiet and trading in a tight range, the bands will contract, moving closer together. This is known as a squeeze. A squeeze often suggests that a period of high volatility is about to follow. It's like the market is coiling up like a spring, ready to make a big move. When the price finally breaks out of this squeeze, it often kicks off a significant trend. When the market is volatile with big price swings, the bands will expand, moving further apart to contain the action. Traders also watch how the price interacts with the outer bands. When the price touches the upper band, it's considered to be at a relative high. When it touches the lower band, it's at a relative low. However, just like with the RSI, this is not a direct signal to trade against the trend. In a very strong uptrend, the price can walk the band, continuously hitting the upper band as it grinds higher. Now, with all these tools, moving averages, RSI, Bollinger Bands, it's incredibly tempting for a new trader to plaster their chart with a dozen different indicators, hoping to find the perfect combination. This is a trap. It leads to what's called analysis paralysis, where you have so much conflicting information that you can't make a decision. The key is not to find an indicator that works all the time, because none do, but to use 1 or 2 that you understand deeply to supplement your price action analysis. This brings us to the most important principle of using indicators, the concept of confluence. Confluence is when multiple independent analytical tools all point to the same conclusion. A signal from a single indicator is just a piece of data. But imagine this scenario. The euro to US dollar is approaching a major resistance level that you identified on your chart. At the same time, a bearish candlestick pattern like a shooting star forms right at that level. You look down at your RSI, and you see bearish divergence suggesting momentum is fading, and perhaps the price is also hitting the upper Bollinger Band. Now you don't have 1 reason to be cautious, you have 4. This confluence of signals creates a much higher probability setup to pay attention to. It's about building a case, not just following a single blinking light. The real skill is in learning how to weave these different threads of information, price action, patterns, and indicators, into a single coherent story about what the market might do next. And this is where the art and science of reading charts truly merge. It's not about finding a magic formula. It's about developing a professional mindset. Because the biggest obstacle you will ever face in the market isn't a complex pattern or a confusing indicator. It's the person staring back at you in the mirror. You can have the best chart analysis in the world, but if your psychology isn't sound, it's all for nothing. This is the great filter that separates aspiring traders from consistently profitable ones. Starts with patience. The market operates on its own schedule, not yours. As a new trader, the temptation is to always be doing something, to be in a trade, to be clicking buttons. But often, the most profitable action is no action at all. It's waiting for the market to come to you, waiting for that high probability setup where the trend, the pattern, and the indicators all align to tell you the same story. It's having the discipline to sit on your hands for hours, or even days, until your specific predefined criteria are met. That's not boring, that's professional. Next comes discipline. Discipline is the bridge between your trading plan and your trading results. It's the commitment to follow your own rules, especially when it's emotionally difficult. When a trade is going against you, fear screams at you to move your stop-loss further away, to give it just a little more room. When a trade is going in your favor, greed whispers in your ear to get out too early and grab the small profit, or to hold on way too long, hoping for a lottery ticket win. Discipline is what allows you to execute your plan like a machine, trusting the analysis you did when you were calm and objective, not the emotions you feel in the heat of the moment. And this brings us to the most critical concept in this entire guide, the one thing that will have more impact on your long-term survival than anything else: risk management. If reading charts is the vehicle, risk management is the seatbelt, the airbags, and the brakes. You cannot and will not succeed without it. The professionals, the ones who do this for a living, are not focused on how much money they can make on a single trade. They are obsessed with how little they can lose. The first pillar of risk management is understanding the risk-to-reward ratio. Before you ever enter a trade, you must know three things: your entry price, your exit price if you're wrong, your stop-loss, and your target price if you're right, your take-profit. Let's say you identify a potential buying opportunity at a support level of $1.10. You decide that if the price drops to $1.09, your analysis was wrong, and you should exit the trade. That's your stop-loss, and your risk is 1 cent. You also identify the next major resistance level at $1.13. That's your take-profit target. Your potential reward is 3 cents. In this case, you are risking 1 cent to potentially make 3 cents. This is a 1-to-3 risk-to-reward ratio. Think about what this means. With a ratio like this, you could be wrong more often than you are right and still come out ahead. You could lose 6 trades, losing 1 cent each time for a total loss of 6 cents. But if you win just 3 trades, making 3 cents each time, you've made 9 cents. Your net result is a profit of 3 cents, even though your win rate was less than 50%. This is the mathematics that underpins a sustainable trading career. Amateurs chase high win rates. Professionals focus on favorable risk-to-reward ratios. The second pillar is position sizing. This is how you ensure that no single trade can ever wipe you out. A common guideline in the industry is the 1% rule. This means you should never risk more than 1% of your total account balance on any single trade. If you have a $10,000 account, you should not risk more than $100 on a trade. If your stop-loss is 1 cent away, like in our example, you can calculate how many units to trade so that if that stop-loss is hit, your total loss is capped at $100. This is not a suggestion. It is a rule of survival. It forces you to stay in the game long enough to let your edge play out over a large series of trades. A single bad trade should be just a small bump in the road, not a catastrophic event. So let's walk through a hypothetical scenario, putting all these pieces together. Imagine we're looking at the daily chart of the euro to US dollar. First, we identify the overall context. We see a clear uptrend, a series of higher highs and higher lows. The market is showing bullish momentum. That's our primary bias. We only want to look for buying opportunities. Next, we see the price has pulled back and is now testing a previous resistance level, which is now acting as support. This is a classic price action concept. We also notice this support level lines up with a 50-period moving average, which has been holding as a dynamic support level during this entire uptrend. Two pieces of the puzzle are now connected. We then zoom in and see a bullish engulfing candle form right at this support level. This is our price action signal, a strong indication that buyers are stepping back in with force. The story is getting clearer. To add a final layer of confirmation, we glance at our indicators. The RSI is at 45, not overbought, meaning there's plenty of room for the price to move higher. The MACD is showing the momentum might be about to cross back up, signaling a potential continuation of the uptrend. Now we have a complete trading thesis. The trend is up, the price is at a key support structure, and a bullish candlestick pattern has formed, confirmed by indicators that aren't overextended. We can now define our trade. Our entry would be just above the high of that bullish engulfing candle. Our stop-loss would be placed just below the low of that same candle and below the support level, protecting us if the level breaks. Our take-profit target would be the next identifiable resistance level, which was the previous high in the uptrend. We calculate the distance from our entry to our stop-loss, and from our entry to our take-profit. We see that the potential reward is 2.5 times our potential risk. It's a favorable risk-to-reward ratio. We use proper position sizing to ensure that if our stop-loss is hit, we only lose 1% of our account equity. We place the trade and we let the market do the rest. We don't meddle. We don't second guess. We trust our analysis and let our predefined plan play out. This right here is the process. It's methodical, objective, and repeatable. This entire journey from the first candlestick to this complete trading plan is just the beginning. The goal was never to give you a secret system. The goal was to teach you the language of the market so you can begin to write your own stories. The next most crucial step is practice. Open a demo account, a trading account with virtual money, and spend months practicing. Apply these concepts. Take trades. Make mistakes. Learn from them without risking a single real dollar. And as you practice, start a trading journal. For every single trade you take, write down the chart, your reasons for entering, your plan, and the outcome. Then write down what you learned. Was your analysis correct? Did you follow your plan? Were you patient? Were you disciplined? Your journal will become your single greatest teacher. It will reveal your personal strengths and your recurring bad habits with brutal honesty. Reading Forex charts is a skill. Like learning to play the piano or speak a new language, it requires dedicated study and thousands of hours of practice. There are no shortcuts, but it is a skill that can be learned. It's a journey of 1,000 charts, and it starts with the first one. You now have the foundational map and the compass to begin that journey. You understand how to read the terrain through price action, how to spot the landmarks with patterns, and how to check your direction with indicators. And most importantly, you understand that the discipline to manage your risk and your emotions is what will ultimately determine your success. The market is a vast and complex ocean of information, but it's not random. It's a reflection of human psychology on a massive scale, and it leaves footprints on the chart. Your job from this day forward is to become a master tracker, learning to read those footprints to understand where the market has been, and to build a probabilistic case for where it might be headed next. The work starts now. Apply these principles, stay curious, and embrace the process of becoming a student of the market.